In today's video, we will learn about perils, loss, and hazard. Perils. Causes of loss. A peril is the immediate, specific event that causes a loss. As noted in the following list, different lines of insurance cover different perils. Property insurance covers losses caused by such perils as fire, lightning, windstorm, hail, earthquake, and vandalism. Liability insurance covers an insured's legal responsibility to indemnify a third party that's harmed due to the insured's negligence. Accident and health insurance covers losses caused by illnesses and accidents. For life insurance and annuities, the covered peril is mortality. Life insurance protects against premature death. However, annuities provide a measure of protection when death is delayed, and the insured would otherwise outlive his assets. Named perils versus special, open perils. Typically, insurance policies define the perils being protected against in one of two ways: specified, named perils, and special, open perils. Insurance contracts that individually cover specified or named perils list those specific perils that they cover. If a loss is caused by a peril that's not listed within the insurance policy, then the loss is not covered. For example, a life insurance policy may specifically name coverage for only accidental death. A health insurance policy may explicitly only cover cancer. A property policy may explicitly cover only loss that's caused by fire and lightning. Again, a named perils policy identifies the perils that are covered under the policy. By doing so, a named peril policy defines the covered losses narrowly. Special or open peril insurance policies don't name the perils that they cover. Instead, these policies begin by stating that they cover all direct causes of loss and then list all of the perils that they exclude from coverage. Since an open peril policy stipulates the causes of loss that are not covered under the policy will therefore cover any peril that's not explicitly identified as being excluded from coverage. For example, comprehensive medical insurance and standard life insurance will typically cover medical bills and pay death claims related to perils other than those expressly excluded. Loss to loss is defined as an unintended and unforeseen reduction or destruction of financial or economic value. In other words, a loss is an unintentional decrease in the value of an asset due to a peril. Losses can be further classified as being either direct losses or indirect losses. Direct losses occur when a person or property is damaged, destroyed, or killed by a peril without any intervening cause. The peril in question is the proximate cause of the direct loss. An indirect loss is also referred to as consequential loss, because the loss is a consequence of, or results from, a direct loss. This distinction is most relevant for property and casualty insurance. A loss can also be defined as either an accident or an occurrence. An accident is an unforeseen, unexpected, unintended, and sudden event that occurs at a specific time and specific place. An occurrence can be any event that causes a loss. Occurrences include accidents, injuries, illnesses, as well as losses that are caused by repeated or continuous exposure to conditions over time. For example, if an individual needs a knee replacement from being involved in a car accident, there are likely some witnesses who saw the accident and, in theory, could provide the exact time and location of the accident that caused the injury. Now, let's assume the individual needs a knee replacement due to years of intense physical activity. In this case, there are no witnesses who could provide the specific time and location of the occurrence that resulted in the need for the individual's knee replacement. Exam tip: every accident is an occurrence, but not every occurrence is an accident. Loss exposure. Loss exposure is the risk of a possible loss. Basically, it's any situation that presents the possibility of a loss. Homogeneous exposure units. Homogeneous exposure units are similar objects of insurance that are exposed to the same group of perils. The larger the number of homogeneous units, similar risks, the easier it becomes to predict loss. A loss exposure consists of loss exposure units. Hazard. A hazard increases the possibility that a peril, a cause of a loss, will occur. Examples of hazards include icy roads, driving while intoxicated, and improperly stored toxic waste. There are three types of hazards: physical hazards, moral hazards, and morale hazards. All of these hazards result from conditions relating to the insured. For exam purposes, a person must be able to distinguish between these hazards. Physical hazards. Physical hazards are physical or tangible conditions that exist in a manner which makes a loss more likely to occur. Physical hazards can be seen, touched, tasted, smelled, or tripped over, thereby causing loss. Poor health and ice on roads are examples of physical hazards. For example, let's assume that an individual leaves a full can of gasoline near the furnace in his basement. In this case, there's a greater likelihood that an explosion will occur than if the individual had left the gas can in his garage. Moral hazards make the loss more likely to occur due to the dishonest character of the insured, who may be more disposed to either engage in criminal activity or cause a loss because of negative habits. The chance of loss increases because of who the insured is. In other words, the chance of loss is greater due to the individual character of the insured. Properly defined, a moral hazard occurs when the insured is much more intentioned and conscious of participating in wrongdoing that's more likely to lead to a loss. For example, a dishonest person is more likely to lie to an insurance company, both on an application and when submitting a claim for loss, thereby creating a higher likelihood of engaging in insurance fraud. Drug use and alcohol abuse are commonly associated with moral hazards. Moral hazards result from the personal or subjective thought process of the insured. In other words, they arise from a state of mind that's related to the indifference of an insured to whatever loss may occur. The insured unintentionally creates a loss situation on an unconscious level. In essence, they just don't care about loss prevention since the property is insured. For example, Alex leaves his car running unattended and the doors unlocked to heat it on a cold winter morning. This act makes it more likely that his car will be easily stolen by a car thief who's looking for such vehicles. On some unintentional mental level, the insured simply doesn't care that this kind of loss may occur, probably because the vehicle is insured. Reckless driving, jumping off a cliff, stealing, racing motorcycles, and a careless lifestyle are often associated with moral hazards. Risk is defined as the potential for, or uncertainty of, loss. Types of risk. Speculative risk is a risk that presents the chance for both loss and gain. Speculative risks are not insurable. For example, investing in the stock market and gambling are speculative risks. Individuals can realize financial gains, or they can lose all of their money. Pure risks present a potential for loss only and no possibility of gain. Only pure risks are insurable. For example, injuries, illnesses, and death represent pure risks because an individual can only suffer a loss in the form of missed work and medical bills or burden survivors through the untimely loss of life. Elements of an insurable risk. It's impossible to insure every type of risk. For a pure risk to be insurable, it must involve a chance of accidental, measurable, and definable loss. General elements of insurable risk include: an insurable loss must be due to chance. Accidental chance means that it's outside an insured's control. In this sense, the individual insured loss exposure unit that suffers the loss is randomly selected. This characteristic helps insurers avoid adverse selection. For example, an insured catches a cold. An insurable loss must be definite and measurable. Definite and measurable means that the time, place, amount, and whether the claim is payable can be documented. For example, the insured's automobile accident occurred at 2 p.m. on Friday and caused $2,000 in damage. An insurable loss must be predictable. The term predictable means that the estimated average frequency and severity of future losses can be calculated. There must be a sufficient number of homogeneous loss exposure units to effectively allow insurers to apply a law of large numbers. For example, 18% of accidents involve distracted driving. An insurable loss cannot be catastrophic. The term catastrophic is from the perspective of the insurer. This is meant to indicate that it's too big and uncertain to be insured. The loss exposure must be reasonable. For example, a war, a nuclear disaster, or a $1 trillion life insurance policy is not reasonable loss exposure. The number of loss exposures, units, to be insured must be substantial. The carrier's actuaries must be able to apply the law of large numbers to help the insurance company predict loss. The premium cost must be economically feasible. A premium is feasible when it's affordable. Also, the premium must be small in comparison to the loss exposure being insured. For example, a healthy 45-year-old male could probably qualify for a 20-year term life insurance policy with a $250,000 face amount for less than $500 per year. A solution to economic uncertainties and losses. Insurance evolved as a practical solution to economic uncertainties and losses. Most insurance contracts pay off financial losses and reimburse the insured. Insurance contracts indemnify policyholders, which means the policies restore insureds to the financial position they experienced before the insured loss. The principle of indemnity states that the goal of an action is to restore an insured to the same financial position they were in prior to when the loss in question occurred. Insurance contracts indemnify insureds. Indemnification also holds to the principle that an insured shall not profit or gain from their loss. In other words, they will not receive more than they lost. Most accident, health, property and casualty insurance contracts are contracts of indemnity. Their purpose is to reimburse for a loss. In contrast, life insurance policies are valued contracts because they pay a predetermined amount regardless of the actual loss that was incurred. Death could potentially strike any person prematurely. When death takes a family provider, e.g., the family breadwinner, surviving family members suffer if they are left without adequate income. Life insurance pays death benefits and creates an instant estate, regardless of when death occurs. On the other hand, when people face the unpleasant prospect of outliving their income, annuities can generate a lifetime income stream to help solve or alleviate this problem. Eliminating the possibility of an unplanned expense is arguably the most significant advantage of insurance contracts. Insurance also lessens the chance of the person suffering loss will be required to pay entirely for a loss out of his funds, thereby allowing for the benefit of greater management of cash flow and providing for better loss control.